business studies. I will be doing the grade 11 business studies, the benefits of a company over other forms of ownerships. Now, in this topic, we will talk about the benefit and challenges of establishing a company versus other forms of ownership and the formation of a company. Now, we are comparing other forms of ownership against a company, right? So there are profit companies, which are state-owned companies, public companies, private companies, personal liabilities, and companies in corporation. So in this topic, you just have to know other forms of ownership and compare them to a company, right? So we will deal with sole traders. Characteristics of a sole trader: only one person owns the business. So a sole trader is maybe a woman selling fat cakes. She doesn't have a registered company, but she has income coming into her business, and maybe she banks the money, and she has to complete her tax return also to SARS to show that to declare all the money that she's getting. So even if you're not a registered business and you're an individual, you're called a sole trader. You pay your taxes by yourself. It's not the company that receives the money and pay what is due to SARS. It's you as an individual, as a woman or a man, dealing in a business which is not registered, but because you are receiving money on a monthly basis or on a weekly basis, SARS requires you to declare that money and show your expenses and everything, because there's money coming in into your account. Or maybe you sell clothes. You go to Durban or Joburg or whatever to go and stock clothes, and then people come and pay you back. Or you sell cakes, whatever that you can sell that you are not registered, right? So your taxes are being dealt with by you as an individual, as opposed to a company, where a company receives money. You are an elected person to act on behalf of the company. But with a sole trader, you yourself conduct business yourself. You receive money. Yeah, it's only one person who owns the business. If the owner dies or retires, this business no longer exists. There's lack of continuity. So when I'm just selling my fat cakes and I get sick and I'm no longer able to sell, then the company has died, right? There's no continuity because this company is not registered. You cannot say you are selling it. In most cases, even the children of the owners are not involved. So the owner is responsible for all the debts of the business. This means that he or she has unlimited liability. So whatever the business owns, she owns. Whatever the business owes, she or he owes. So that's how there is no separation between the owner and the business. A sole trader is usually a person who has business sense but does not want. Maybe there's so many people who are even building houses who are sole traders, but they feel like companies are more complicated and they just feel like the administrations of companies is a lot opposed to just operating as a sole trader. Now, a formation of a sole trader. This is how a sole trader comes into existence when we're talking about the formation. There are no legal requirements when forming a sole trader, so you can just decide today that I'm a sole trader. I am going to sell a particular product to people. That's how it works, right? You have to make sure that you comply with any required laid down by local authorities. A license may be necessary. If maybe you're going to sell in a metropolitan town, then you need a municipality to approve the space where you are selling from and all that, but you don't have company documents like a memorandum of incorporation and all those stuff, because it's only you deciding to cater a service to the public. So we have advantages and disadvantages. Advantages are the pros, what's nice about forming a sole trader, and disadvantages are the downside, like what is bad about being a sole trader? What would make you not to go for this type of ownership? So advantages is that it's easy to form, no special formalities, no costs involved. As I've said, to forming a sole trader is just you deciding. And disadvantage is that unlimited liability. Whatever the business owes, you owns. Whatever the business owe to people, you yourself owe it. So there is no unlimited liability, meaning that you and the business are one thing. People cannot say they are suing the business. They're taking the business to court. No, people are taking you to court. So whatever that happens to the business reflects back on you because you are the business. No continuity if owner dies. Your child has to start their own sole trader if you die, right? There's no continuity. They cannot continue under you. So limited resources and difficult to expand, because when you're looking for funding, most of the time the funding institutions want you to register a company. So for you to fund a sole trader is very, very difficult. And then the next form of ownership, we have partnership, where you and 20 other people can decide to be in a partnership, right? So a partnership consists of 20 partners or owners. If one of the partners resigns or dies, the partnership no longer exists. So we come here, we share a part of this business, so and so takes which percentage. Doesn't mean that we have to have the same percentages to form a partnership. It can be 60-40 if we are 2, or we can decide if we are 10 for each of us to get like 10%, for it to be 100, or whatever that you may decide on. So all partners are jointly and severally liable, meaning that all the debts of the partnership, the partners are liable for. Just like a sole trader, a sole trader is responsible for liabilities of their business, right? So as the partnership, is just that those expenses and liabilities are jointly several by the partners. So the partners are jointly several in their liability, right? So they both all share in that liability. And then the other thing, the partner is an agent of the business and acts on behalf of the other partners when conducting business. So when I am representing a partnership that I'm part of, I'm an agent of that partnership. It may be formally or orally. So it may be formed orally or in writing. So we can just decide orally that we're forming a partnership. That will stand by law, or we can write it down and say, this is our partnership. We are forming this partnership. And if the owner dies, the partnership dies. So if we are 20 and we have agreed on this and this, if one of us dies, we have to start the partnership afresh. We have to sell everything, liquidate the business, and then share everything amongst ourselves and start a new partnership under new rules and new members, because a previous partnership, the member had died. Now we need to start as if we were 20, we need to start as 19 partners under new rules, under a new contract, right? Whether it can be orally or in writing. A partnership may be formed for a once-off venture or for a long time. We can just decide to be partners to perform one specific task, right? So you can just decide, no, we partners. And businesses can also be partners for a specific cause. Let's just say we wanted to supply something and we decided to form a quick partnership just to be able to carry out that assignment. And after the assignment is done, the partnership has dissolved, which means the partnership has ended. It is not a legal personality. The partners and the partnership are not separate. So the partnership and the partners are one thing. It's not a partnership. It's not a legal personality, right? So you cannot say, no, the partnership is the one that did you wrong. If you've done a business and people are coming to complain or want to see, you can say they can't sue the partnership. They're going to sue the partners, because the partnership is between the partners. The partnership is the partners. Now, Let's go to the partnership agreement. Includes the following, so you have to know what is included in the partnership agreement: the name of the partners, the name of we have the name of the partnership, the name of the partners, the duties of each partner, the aim and the nature of the partnership, the contribution of each partner, and so on. I have written all of them. You can see there the agreement includes all those that are written there, and we have advantages and disadvantages, pros and cons. Advantages that it's a greater financial capacity. It means a lot of people are coming together with their different financial capabilities coming to form this. So there's greater financial capacity because there's a lot of people investing in this partnership. There's freedom and flexibility in decision making, combines special skills. Sometimes this person has this particular skills, this one has this, so they contribute towards the partnership and make it great, right? And we have disadvantages. It's easy to dissolve and can be unstable. So if someone decides like, oh, I am done with this group of people, the partnership has dissolved and they have to start over again. So it can be quite unstable. As much as it's easy to dissolve, that can just be a very unstable environment to be into. There's unlimited liability, which means the partnership and the partners are one thing. Can be difficult to raise large amounts of money because also financial institutions like to partner registered companies and as opposed to partnerships, right? We have now another close corporation. A close corporation is a simple, inexpensive way of forming a legal personality. So a close corporation is a legal personality. The members of a close corporation may be from 1 to 10. The name must end in CC, meaning close corporation. Maybe we say Madiba Close Corporation. It will be Madiba CC. It is separated from its members' owner, so it's a legal personality, right? This is better as opposed to sole trader and partnerships. But every man do what suits him. So a close corporation has unlimited continuity. It can continue even one member leaves, so it has unlimited continuity, right? It does not mean when one member leaves, we are now no longer in a partner. No, it can also even be sold. A change in members does not affect the continuity of the business. The members are not liable for debts of the business. Now, that's a very nice one. They have limited liability. A document called the founding statement is drawn up to form a CC. Ownership is expressed as a percentage interest in the business. The total interest of all members of the CC will be equal to 100%, right? So if you are 4, you each take 25, but your total interest of members has to equal to 100%. Now, we have the contents of the founding statement. We need to have a founding statement to have a close corporation. A founding statement is used to form a close corporation. This document is a written agreement. It must be registered with the registrar of close corporation. So this is a registered business. There is admin involved in it. So those are what should be in the founding statement. I'm not going to read it. You have it there. You can go through it. And then we have advantages and disadvantages. It's a legal entity. It does not require audited financial statements, so you don't have to have an auditor coming in yearly to audit the financial statements, or members may take part in management. It is limited liability. It's separate from the members, easy to register and start. Disadvantage, only 10 members allowed. Members are bound by the actions of each other. So if one behaves in a certain way, it affects the others. Needs to have an accounting officer. You need an accounting officer, but you don't have to be external audited. Taxes as if it were a company. So it's taxed like a company. Last time I checked, companies were taxed at 28%. So there are benefits and challenges apart from advantages and disadvantages. So more owners means the possibility of more capital. More capital means greater possibilities for expansion and growth. Shareholders appoint a board of directors that gives more efficient management. It's a legal entity, a separate legal entity. Continuity exists, which means it can exist even if one member decides to go. The challenges are it's expensive and complicated formation procedure, many legal requirements to comply with. If the directors are not competent, then the shareholders' investments may be at risks, right? That is what we have dealt with. Those are other forms of ownerships compared to a business or to a company. Now we are going to come to companies, right? The formation of companies. We need a memorandum of association must be drawn. Ne? The company name is reserved and a fee are paid. So when you come, you go to the Companies and Intellectual Property Commission, CIPC, and you go on their website and register a company. These are the steps that are going to be followed. So then you are going to fill in a form, fill in a name that you want your company to be called by, and the company name will be reserved and fees are paid to the Register of Company and Intellectual Property Commission. The certificate after the name has been approved, the certificate of commence business is submitted with the formation documents. The company opens a bank account. Yes, then the name is approved. Everything is fine. You've been registered. Now you can open a bank account. You can be registered for all that has been written there, for COIDA, for VAT, for UIF, and all that, right? And then the memorandum of association. What is a memorandum of association? It defines the scope of a company and includes the following: the company's name, address, starting off the limited liability of shareholders, the amount of share capital, and the purpose of the company, right? So remember, the memorandum of association, this is what you have to write when you ask what is it, what should be included in the memorandum of association. These are the points that you include. Benefits and challenges of establishing a company versus other forms of ownership, right? Yeah, so this we have the articles of association. Yeah, the articles of association indicate the internal management regulations and include the following. So that's what the articles of association include: name of directors, the way in which profit will be distributed. That is that. And then we have a prospectus. They like this question a lot. What is involved? What is a prospectus, and what is included in a prospectus? A prospectus is something that you use to sell yourself. Universities and other institutions do offer prospectus, where you know where this institution is coming from, what does it offer, a different option, who to call for what. Yes, a prospectus is just merely a small limited page books or a flyer, or it can be done in a way that it is able to summarize all the information of a business or an institution. So a prospectus must convince the public that they should buy shares in the company, right? So here you see it's something that you're selling. So for a company, they use a prospectus to sell themselves, to sell the shares of the company. It has to be the purpose of the offer. Why are the shares being sold? The share capital, the shares issued, how much shares are being issued, the property owned by the business, preliminary expenses, amounts due to the promoters who are going to promote these shares, and particulars of shares and all that. So this is what needs to be involved. This is what needs to be included. And now we are saying, yeah, the minimum subscription, those are still what should be included in the prospectus. And then we have members of the public have 60 days to reply to the invitation. So a business want to sell its shares, that what should be included, and people who want interested in buying these shares have 60 days to respond to this invitation, this prospectus. Ne? Minimum subscription before a public company may commence. This is for a public company, ne? A company that will eventually be listed on JSE. Right? This is the formation of that company. They can invite people. So the minimum subscription before a public company may commence, the company must prove that enough shares have been issued to cover the cost of launching the company and any other initial expense that may be incurred. Right? So before a public company is formed, this is what they do. They have to sell shares. So there's a difference between a private and a public company. And then we have underwriting. To ensure that minimum subscription is met, a bank or other financial institution may guarantee to buy any shares not yet sold in order to make up the minimum capital required. So if a certain amount of shares that or it is required to be met by a company issuing that prospectus is not met, a certain institution may bind itself that it will buy the remaining capital in order for the capital that is needed for the company to start would be available. So we're going to talk about a private company. When we talk about a private company, we're talking about a company that even one person can start. So one up to a maximum of 50 people may start a private company. The name of a company must end in Pty Ltd, Proprietary Limited. So you can say Menzini Pty Ltd, right? The company can only expand by selling shares up to 50 shareholders, right? In a private company. Shareholders have limited liability. If the company goes insolvent, the shareholders are responsible for the debts of the business in their personal capacity. They are only liable for amounts invested in shares in the business. So, shareholders are have limited liability, right? So they will have to check if a business has to be insolvent, if the business has to dissolve, what have they contributed towards that business going into that state. If it is find out that there's something that they did for the business to be in a particular state, then they will pay for the debts of the business. But if not, then they will not pay. A company is separate, right? A private company has unlimited continuity, just like a closed corporation. It is a legal entity. Its form of ownership can sue or be sued in its name. So you can take the company to court, you can take ShopRite to court, not the CEO or the owner of ShopRite, if you have encountered any form of informality or a bad service from ShopRite. Now, a private company, yes, is a legal agent. Shareholders can sell their shares on Johannesburg Stock Exchange. The public are not invited to take up shares. So only in a public company that investors are invited to buy shares. But in a public company, no one is invited. So I can sell my shares to someone without even advertising, without my shareholders even knowing. A public company, a minimum number of shareholders is 7, and maximum depends on the number of shares issued. We can have 100 shares, or whatever amount of shares that we have. 250,000 shares. The name must be in words. The name must include the words, that is a typing error. The name must include the words limited or Ltd. A prospectus is issued to invite the public. So this prospectus issue only affects public companies, not private companies. Private companies are big companies, like those who are trading shares on the JSE, like Pick n Pay, like ShopRite. We have FNB, it's Rent Bank. No, that's not the First Rent. Yes, and all those APSAs, and yes, those are big ones that are trading on the JSE. That is everything that you can know them of a company. Factors to be considered. Okay, so another thing that we have to do is factors to be considered when deciding on which form of business to choose, right? You have to look at capital. How expensive is that form of ownership? Management. How will the business be run? Adaptability. Will the business be able to adapt to challenging situation? Profit sharing. How will the profit be shared? Control. Are there voting rights? Who makes the decision? Number of owners. How many number of owners are allowed? Income tax, continuity and liability. And then also tax implications. All businesses in the formal sector pay tax. Taxation is one of the factors that are considered in deciding on the form of ownership. Tax is paid usually as a percentage or rate of profits made by each business, right? So that is all the information about tax implications of businesses. And then there is also VAT. Now VAT is 15%, not 14%. VAT is collected at every stage in the production and distribution process of goods and services. Businesses with an annual turnover and self-employed people earning more than 150,000 a year are required to register as VAT vendor. So when your business is making more than 150 a year, you're required to calculate as a VAT vendor. Now, the next video, we will do avenues of acquiring. Yes, avenues of acquiring a business for term 1. Thank you very much, guys, for watching. Share these videos with your classmates, people you think may need it, and without waiting any time. Thank you and God bless.